Welcome to everyone. Myself Ganesh NK, Assistant Professor of Commerce, subject Corporate Accounting. In this session, I am going to discuss about super profit method theory under Goodwill chapter. Now, what is super profit? In layman's language, super profit is the difference between actual profit and normal profit. See, what are the reasons for earning super profit? Maybe several factors can be attributed in this context. It may be the efficiency of the management, it may be reputation of the organization, or it may be the courteous service rendered to customers, or I can say the cordial relationship between the management and its employees. Now, let me discuss about super profit method. Super profit is the excess of estimated future maintainable profits over normal profit. An enterprise may possess some advantages which enable it to earn extra profits over and above the normal profit that would be earned if the capital of the business was invested in some other business with similar risk. The goodwill under this method is ascertained by multiplying the super profit by certain number of years of purchase. My dear students, I can say that super profit is the difference between actual profit and normal profit. And then I have discussed about the reasons for super profit, the reasons attributable for super profit. Now, let me proceed further. The profitability is the most important factor in valuation of goodwill. The main emphasis is on future profit of the concern, whether concern will be able to increase in its profit in future. Since the profit earned in past provides a base for the concern's future profit, the process of assessment whether a concern will maintain its profit in the future is otherwise called future maintenance profit. I repeat once again, what is future maintenance profit? The process of assessment whether the concern will be able to maintain its profit in the future is termed as future maintenance profit. While estimating the future maintenance profit, one must consider the following factors. Number one, all normal working expenses should be included. Any appreciation in the fixed assets should be excluded. Any appreciation in the value of current assets should be included. Provision for taxes should be included. Income for non-trading assets should not be taken into account. Transfer to general reserve should be excluded. Dividend to preference shareholders should be excluded. Non-recurring expenses should be included. Average profits of past years should be considered. Now, let us understand the steps involved in calculating goodwill under super profit method. Step number one, calculation of capital employed. What is capital employed? Capital employed is the aggregate of shareholders' equity and long-term debt or fixed assets and net current assets. Step number two, calculation of normal profit by multiplying capital employed with normal rate of return. Step number three, calculation of average maintainable profit. Step number four, calculation of super profit. Super profit can be calculated as follows. Super profit is equal to average maintainable profit minus normal profit. Step number 5. Calculation of goodwill by multiplying super profit by number of years of purchase. Now, let me explain you in detail. Step number 1. Calculation of average capital employed. So, my dear students, I have told you already what is capital employed. Capital employed is the aggregate of shareholders' equity and long-term debt or fixed assets and net current assets. It means capital employed is equal to fixed assets plus net current asset. Net current asset means working capital. In other words, current assets minus current liabilities is equal to net current assets. Now, step number 1, calculation of average capital employed. We must consider the market value of assets, land and building, plant and machinery, furniture, equipment, stock, debtors, bills receivable, cash in hand and cash at the bank, total market value of assets. From this, we are deducting external liabilities. External liabilities includes debentures, long-term borrowings, mortgage loan, creditors, bills payable, provision for taxation. This will be our what? Total external liabilities. Then what is capital employed means? Capital employed is the difference between total market value of assets minus total external liabilities. External liabilities comprises debenture, long-term borrowing, mortgage loan, creditors, bills payable, provision for taxation. Later on, we have to calculate average capital employed. Average capital employed can be computed as follows: capital employed minus half of current year's profit. While calculating half of current year profit, we must consider certain items like interest on investment, non-trade, then partners managerial remuneration. Then after deducting it from the current year's profit, we must divide it by 2. Thereby we are getting half of current year's profit. Capital employed minus half of current year's profit is equal to average capital employed. The capital employed represents fixed assets plus net working capital. This represents equity holders of fund plus long-term borrowings. Following items to be included in determining capital employed: all fixed assets less depreciation written off, trade investments, all current assets. Following items should be excluded: long-term liabilities, all current liabilities, intangible assets including goodwill, non-trading assets, fictitious assets. Generally, average capital employed is used instead of capital employed since profit earning is a continuous process during the year. So, first step, we must calculate capital employed. Means I can say average capital employed. What is average capital employed? Average capital employed means capital employed minus half of current year's profit. So what is capital employed? Capital employed is nothing but total market value of assets minus external liabilities. Then what is half of current year's profit means? I can say current year's, while calculating current year profit, we must deduct interest on investments being a non-trading income, then partners managerial remuneration. Whatever the balance we get from this, we must divide it by 2. And finally, from the capital employed, if I deduct half of current year's profit, we are getting average capital employed. Step number 2, we are calculating normal earnings. What is normal earnings means? Average capital employed into normal rate of return. I repeat once again, what is normal earnings means? Normal earnings is equal to average capital employed into normal rate of business. What is normal rate of return means? The rate of return anticipated in normal course of business. Step number 3, calculation of adjusted average annual profit. Step number 4, calculation of super profit. Super profit is equal to adjusted average profit minus normal profit. Step number 5, goodwill calculation. Goodwill is equal to super profit into number of years of purchase price. To summarize the calculation of goodwill under super profit method. Step number 1, calculation of capital employed. What is capital employed? Capital employed means the market value of assets minus external liabilities. Step number 2. Calculation of average capital employed. What is average capital employed? Capital employed minus half of current year's profit. Step number 3. Calculation of normal profit. Normal profit is equal to average capital employed into normal rate of return. Next step, calculation of adjusted average annual profit. After calculating adjusted average annual profit, we are calculating super profit. What is super profit? Super profit is the difference between adjusted average profit and normal profit. In other words, super profit is equal to adjusted average profit minus normal profit. Finally, we are calculating goodwill. What is goodwill under super profit method? Goodwill is equal to super profit into number of years of purchase price. Thank you, my dear students.